Hi everyone! Welcome back to our YouTube channel. My name is Samantha Estrina, and today I'm going to be showing you my mind mapping video consists of 8 weeks of corporate finance class by Professor Roy Samble at IPMI International Business School. It has been an amazing and thrilling 8 weeks of the class because although the class was super hard, especially for me because I don't have any background in finance before, but somehow we all can manage well and can be happily following the class because Professor Roy Samble had taught us with a fun and very interactive way in the class. The class is running with no judgment at all. Everybody's participating, everybody's contributing, and no one left behind. And he always taught us to be brave in making mistakes because from our mistake we can learn something new. Okay, and we have 3 stages of learning in the class, which the first one was the individual learning, the second one was the group discussion, and the last one was the class interaction. And the objective of the class itself is to give the student the problem-solving skills in finance, especially from the POV of management, which means the internal, and from the POV of investors, which means the external. So basically this video is the mind mapping video aimed to complete our final assignment. And if you like this video, don't forget to like, subscribe, and comment down below. Thank you. In this video, I will tell you some activities that we did to sharpen our skill in finance. As I mentioned before, the class started with the famous motto from our professor: it is okay to make mistakes, as long as we try harder, because from our mistake, we can learn something new. Mistakes are proof that you are trying harder beyond our comfort zone. In the class session, we did very interesting activities such as the investment simulation game, watching relevant movies, quiz, book review, and event analysis. Okay, now I'm going to mind map the whole session of corporate finance class. The first part is financial management. Financial management is an optimal orchestration of internal and external financial resources towards significant and sustainable value creation. What to manage in financial management is capital structures. It refers to lower debt to equity ratio. Working capital management refers to permanent versus non-permanent current assets and choices of working capital financing. Asset structures refers to reduction of fixed asset ratio. Revenue management refers to higher portion of recurring revenue. Cost of management refers to higher portion of lower fixed cost portion. Cash flow management focus on 5 principal cash management. Growth management focus on organic and partnership growth. And the last one is risk management, lower risk appetite. In the financial management, there were also principal agent problem. Principal agent problem is an asymmetric information problem. The owner often cannot observe directly day-to-day decision of the management, especially in the big company. To overcome this, there were some steps. The first one is create an employee share ownership scheme. Second, long contract with senior managers. And the last one is long-term stock commitment. And there were 3 things that needs to be done by GCG. There were conflict of interest, asymmetric information, and moral hazard. You can also solve this by good system and good recruitment. Solution to the problem can be mitigated with GCG, or good corporate governance. We call it Tariff, which stands for transparency, providing relevant information among stakeholders. Accountability, professional responsibility and position. Responsibility, social and corporate responsibility. Independency, each department or stakeholders not dominating or interfere each other. And the last one is fairness, fair principle to protect all shareholders and their rights. The goal in financial management is value creation. Creation when the company generating growth with 4 cornerstones of corporate finance. 1. Core of value creation. Driven by returns on capital, growth, and cash flow. Second, conservative of value principle. You cannot create value by rearranging claims on cash flow. The third one is expectation treatment principle. The more investors expect your share price, the better you must keep up with the performance. And maybe that's why they call it treadmill. We always have to keep up with the investor's expectation. And the last one, best owner principle. Business value depends on the owner's capability. And we can always link it into 5 business essentials according to Ramcharan Way, which are cash, profit margin, velocity, growth, and customer focus. So basically, how to create value? There were 3 things. First, create return on capital. Second, create growth. And the third one, translate it into cash flow. And the value indicator market are fundamental performance and communication with stakeholders. And this should be balanced. The second one, we learn about time value of money. Time value of money is the concept that sum of money has greater value now than it will be in the future due to its earning potential. Time value money, for example, $1 today is $1 in the future plus interest. $1 today into its equivalent in the future called compounding. $1 in the future into its equivalent today is called discounting. And the opportunity cost is the interest we could have earned and received sooner. In the compound value, we see there were future value and net value. It is used to see time value of money, especially with the famous method called Rule 72. For example, how long does it take to double 5,000 at compound rate of 12% per year? The answer is 72 for 12% equals to 6 years. So to double 5,000, you need 6 years to take. Time value of money usually applicable for mortgage, car loan, life insurance, time deposit, and etc. The third one, we learn about capital budgeting. Capital budgeting is the process of business undertakes to evaluate potential major projects for investment. So basically, the planning process for investment in long-term assets. For example, if we make constructions of a new plantation or big investments, are the examples of projects that would require capital budgeting before they are approved or rejected. There were 4 methods to use to cover the risk. The first one is payback period, for counting how long does it take to cover the initial investment. This method is important but has weakness because it is subjective, not considering all cash flow from the project, not considering time value of money, not considering required rate of return, and that's why we need to also look on the NPV. The NPV is the better method to evaluate feasibility of the project compared to any other method. NPV should be always positive. If your NPV is minus, you cannot create value. The third one is profitability index, or PI. When projects are acceptable, if PI is bigger than 1. The last one is internal rate of return. The internal rate of return, or IRR, is a way to measure potential investment return without considering external factors. It is similar when you put your money in the time deposit, you will get interest rate. And if you put your money in the project, you will get IRR. Now, above all of these points I've mentioned, we need to know about the security analysis. In this chapter, we learn about investment fraud. In security analysis, we learn about two types of investors. The first one, passive investors, who just follow the market and do investments regular basis, while active investors are doing fundamental analysis and see the effect of domestic and global economic movement to the industry and the company analysis. They also analyze the intrinsic value comparing to the market price. If the intrinsic value is bigger than market price, they will buy. If the intrinsic value is less than market price, they will sell or short sell. And if the intrinsic value equals with market price, they will hold the price. And also, the analysis of the company through the financial statement, including their balance sheet, cash flow, and profit and loss. They see if the company is healthy or not healthy by measuring these ratios, which are from the profitability, liquidity ratio, efficiency ratio, leverage ratio, and market value ratio. They also benchmark with a similar industry to check the performance and the positioning with DuPont analysis, which is return on equity. They also do the technical analysis based on the historical data about company, see the pattern about the company and adjust their investment in regular basis, and it can be daily, hour, or weekly basis. And they also see the trend and the gap. The last part is portfolio theory. This is the quantitative analysis of how investors can diversify their portfolio in order to minimize risk and maximize return. In this theory, we analyze the potential return, actual return, and required return using capital asset pricing model. The risk itself is classified into total risk, systematic risk, which related to overall micro factor, for example, recession, and related to beta. The higher the beta, the higher the systematic risk. And unsystematic risk, which all related with the specific company actions. For example, if the company loses the bidding, it can be mitigated by diversification by choose other company comparison with low correlation. Beta equal to systematic risk of the company divided by the variance of the market. When beta is lower average, which is 1, the company does not significantly affected by market movement. But if the beta is higher than 1, meaning the company are affected by the symmetric risk of the market movement. Moving on to the capital structure, which talking about the long-term source of fund that can be debt or equity. Capital structures is the ratio of debt versus overall capital. Factors are determine optimal capital structures can be seen from company benefits and the expected cost of financial distress. We have to be careful with this financial distress because it can be accompanied from early impairment, insolvency into bankrupt. You can see the integral of financial distress. The last topic is about fraud risk management. In this topic, we learn how these financial management activities need to be secured by fraud risk management. We learn about triangle of fraud, which is framework used to explain the reason behind an individual decision to commit fraud. This fraud triangle consists of 3 components. The first one is perceived opportunity, the second one is perceived pressures, and the third one is rationalization. But as the management, there were several ways to prevent fraud, such as create code of conduct, whistleblowing program, separation of duties, audits, create SOP, setting KPIs, assessment program, incentive scheme, and many more. And when the company is already bleeding because of the fraudulent and false in management, there were also ways to survive and transforming the business with the corporate structuring. Corporate restructurings consists of short run, medium run, and long run. In the short run, there were stop the bleeding, financial restructuring, and temporary pivoting. The medium run is strategic realigning, and the long run is redefining core business and change the new way of strategy in doing business. We also learn about the dividend policy and how it affects to the tax benefit, and by consistently share dividend, it will show the good performance of the company. A form of statement that the company is healthy and liquid enough to handle cash. That's all about the mind mapping of corporate finance class by Prof. Roy Samuel. I especially wanted to say thank you to Prof. Roy for the fun and highly effective class, and for the encouragement during the class to learn as much as we can and to actively seek information from various sources to enrich our knowledge. And for you who watched this video, I hope you enjoy it. Please like, subscribe, and comment down below. Thank you!